Today I look at over 19 money market accounts to find the best money market account. Which is the best money market account? I compared money market accounts from Vanguard to Fidelity to Schwab to iShares. I compared money market mutual funds and money market ETFs. I'm also going to explain what floaters are, and I'm not talking about something in your toilet bowl. I'm talking about money market ETF floating rate bonds. Please press that like button and subscribe. It really helps small channels like this. If you have Vanguard and Fidelity, you already have good options to choose from. They already have pretty good options, and Vanguard has the #1 option, in fact. Vanguard has the Vanguard Federal Money Market Fund, VMFXX mutual fund. It has one of the highest yields and the best performance out of all of them. It has a 4.51% 7-day yield. It's got a really low 0.11% expense ratio. What I like best about this money market account is it has one of the highest yields, one of the lowest expense ratios, and the best performance. The 1-year return is higher than all these other mutual funds. The only downside about this is it has a $3,000 investment minimum. So even if you buy it from E-Trade or Schwab or TD Ameritrade, you buy the mutual fund from them, you still have to have at least $3,000 to start out with. So in that case, I have some other options also. Now, if you don't have $3,000 to put in there, let's say you've got your money already invested in a brokerage account and you don't want to have to sell some of your stocks for that. It probably wouldn't make sense to sell stocks that you already, long-term stocks for a money market account. But if you don't have the $3,000, there's other options. So you can invest in the Schwab Value Advantage Money Fund Investor Shares, SWVXX. Now it has a higher expense ratio, 0.340%. But the yield is almost the same. Now this one has a 4.48% yield. 4.48% yield. It invests in commercial paper and CDs mostly. So it's still very safe, and all of the securities they have has a very short duration, and the price is pretty stable on this. So this is almost as good as Vanguard. It's better than what Fidelity has because Fidelity's fee is creeping up, and Fidelity's yield is about maybe 1/4% less than this. So another option from Schwab is a government-only money market account. It's a Schwab Treasury. It's called the Schwab Treasury Obligations Money Fund Investor Shares, SNOXX. It has the same 0.340% expense ratio, but this one invests in government securities and repurchase agreements. This one has a 4.26% yield currently, which is pretty high. This is all government securities, so it's going to be a little bit safer than the previous one, but I would probably go for the previous one myself. If you want an ETF, I have an even better option, I think. So I found this. It's called the iShares Treasury Floating Rate Bond ETF. It's the ticker symbol is called TFLO. What do I really like about this? It's got a very low 0.15% expense ratio, and it only invests in government U.S. Treasury floating rate notes. Now it only holds 8 floating rate notes. The floating rate notes, the Treasury has one auction every quarter, and the Treasury will pay out. You can buy these directly from Treasury Direct, or I believe I tried on Fidelity, but you have to pick the right time, I think, and it's not as easy of a market as the traditional bonds. And so these floating rate bonds, there's only one type of bond they invest in. The 0.15 fee is low, but they're not doing a whole lot of work. They have 6 holdings, and it's all from the U.S. Treasury. But the great benefit of this is you can buy and sell it anytime you want. You don't have to worry about finding a buyer. If you want to sell this early, these are 2-year notes, but they adjust every week. You're basically getting something very close to the Fed funds rate as it keeps going up. And then when you want to get out of this, you can just sell it like a stock. It's very easy. So that's what I really like about this. So you've got the 4.56%. No, it's actually 4.58 now. It just went up from the other day, I guess. 4.58%, 30-day SEC yield. That's higher than all of them so far. The previous one I showed, Vanguard, was 4.5%. And this is going to be very safe, just like the Federal Money Market Account from Vanguard. Now, if you want an even higher return than this, I have another one. It's called the iShares Floating Rate Bond ETF. And this is a very similar name, but this one is not just treasuries. This is a bond. This is called FLOT. It's got a low 0.15% expense ratio. Now this one doesn't invest in US Treasuries. It invests in corporate bonds that are floating rate. So they're also, it's known as floaters. So it has access to 300 short-term investment grade bonds. And these are investment grade. They're not below the BBB rating. So there's a very low risk of default. The yield on this one is a whopping 5.11%. That's higher than any of these. Just like the previous one from iShares, it pays the dividend or interest every month, not every quarter. So if you were to buy the Treasury bonds, it pays every quarter. But if you buy the iShares floating rate bond ETF or the Treasury ETF, it pays interest or dividend every month. So that's a nice benefit also. I've added several of these ETFs for the money market mutual fund comparison. And I threw in a few that I know that aren't going to be good contenders for a money market, and they're not sold as such. But I just threw them in there so you can see the difference in performance. So for example, this starts from 2020, before the virus outbreak, and then it goes until February 14th, which is today. The first one I have is well, let's start at the bottom here. The worst performer, it lost 6%. That doesn't include the yield, so it's still earning the yield, but the price of the security went down 6.32%. It actually went down a little bit lower for a little while. But this one is BSV, which is Vanguard Short-Term Bond ETF. It has a 4.31% yield. It has the average security duration of 2.8 years, which is one of the longest out of these. 2.8 years, that's a long time. Now the next one, going up from the bottom, the red one is SCHO. That is Schwab Short-Term US Treasury ETF. It has a yield of 4.27%, and it has a average duration of 2 years. So it's also a longer term. And we know that the long-term bonds are still below the short-term rate. And that's why the price keeps going down, so that the yields will eventually go up at some point. But it's going to take a while before that happens. This one is not really suitable as a money market. Let's go up to the next one. The next one that went down quite a bit. If you look here, this light colored turquoise blue, it went down slightly. This one is the VUSB. VUSB is the Vanguard Ultra Short Bond ETF. Now the average duration on this one is 1 year. So it's also a fairly long-term holdings. And it has a fairly high yield, 4.66%, but it's got kind of a longer term bond, so it went down. But it didn't quite go down as much as the other one because it's slightly shorter term. So I would probably not consider any of those three. Although the turquoise one is not quite as bad, but I think there's better ones out there. So the other ones that I've added, the ones that you see that are fairly stable, you see this orange one up here. The orange one is fairly stable. That's SGOV. SGOV is the iShares 0 to 3 month Treasury Bond ETF. It has a 4.27% yield, and the average duration is 40 days. 40 days, so it's a shorter term. So you can see the price doesn't go up or down much, and that's basically something I'm looking for. I don't want something that goes up and down. This is basically temporary holding until I can invest the cash in something better, like an index fund or a stock when it reaches the price that I like or I want. So that one's not bad, but the yield is a little bit lower than some of the other ones. Now another one that I like is this one here in green. If you look, this one is pretty stable all the way back. Let's close this right here. If you look here, it dipped a little bit, during the virus outbreak, but not that much. It's been fairly stable. This one is TFLO, and that's going to be the main one that I like, I think, the best. Now this is the iShares Treasury Floating Rate Bond ETF. It has a 4.56% yield. So it's got a fairly high yield, one of the higher yields, but the price is more stable, and it's an ETF. Now the average, this only has 8 holdings. It basically buys Treasury notes, 2-year Treasury notes, floating rate. Now you're going to think, oh, 2 years, that's a long time. Well, it's not actually a long time because the rate adjusts every week. It automatically adjusts every week. That's the great thing about it. So you've got a lot of stability, and whenever the rate increases, it goes up or down quickly. So as long as the rate keeps going up, this is going to be great. Ideally, this would be the one that I would want to pick. If I were going to hold it for a while, I would pick this one until the rate peaks out before it starts going down, and then I would switch to a longer term one at that point and get rid of this one. But that's pretty far away right now. Nobody knows when that's going to happen. So other than that one, the pink one also looks pretty good. The pink one you see here has been stable. This is SHV. Now SHV is the iShares short-term bond ETF. It has a 120-day holding period. The average securities it holds for 120 days, and it has 32 securities that it holds. What other ones are left? So we have some other ones that are left that I still like, but they're not quite as stable. Now you see here, right after we had the virus outbreak, both these yellow and the green ones here, they're basically the same index. It's the Bloomberg US floating rate less than 5-year index. Now this invests in corporations, not Treasury. So corporate bonds that are floating rate, so it's a variable rate loan, but they're investment rated. It's not junk bond rated, so that it's less likely that they're going to default. But you see here that when people got scared, this went down around 12% in a very short period of time, and that's a lot for something that would be a money market. And you see here that it's dipped, it's went up and down quite a bit, so there's extra risk involved. Now FLOT, which is the yellow one here. FLOT is the iShares floating rate bond ETF. Now it's called floating rate, but there's no treasuries in this. It's all basically foreign bonds and US bonds, mostly financials. And the same with the other one. The other one, the green one here, is the FLRN. It's the Bloomberg Investment Grade Floating Rate ETF. Now, both these, the highest yields. FLOT has a 5.11% yield, and the other one has a 5.06% yield. And those yields should be going up the next time the rate goes up. So it's got the highest rates out of all of these. So that's what I really like about it. So when you set aside this one kind of exception here where it went down quite a bit, it hasn't really went down that much, and the rates still aren't crazy high to where the defaults are really going to start getting really bad, and their investment grade it shouldn't be too bad. So I would say if I need to hold the money a little bit longer and I want a little bit extra yield, I think both of these could be good options. And then for stability, I would say SHV, SGOV, or TFLO would be great. These are out of all the ETFs. I was looking for money market accounts, and I was looking for the highest yield and the best money market account, and I think I may have found the best money market account. Now it's not a traditional money market account. It's a iShares floating rate ETF. It's called TFLO, TFLO. It is the iShares Treasury floating rate bond ETF. This is the only one I could find that actually it buys the US Treasury floating rate notes, which are notes that the US government, the Treasury, creates. It's a 2-year bond that resets, the rate resets every week. So now that the interest rates are going up, this seems like it's doing perfectly right now. It's a higher yield than you get with the money market. This is a 5.11% yield versus most money market accounts are only paying about, I shouldn't say only, they're paying about 4.5% or maybe a little bit less. This offers pretty much the greatest stability because it's all US government debt. It's not corporate debt. But they also have another one here that I want to show you. So I bought 2 of these today in one of my accounts where I have some money sitting. There's the iShares floating rate bond ETF. Now this is not the safest one. The safest one is the TFLO because they only hold 8 securities, which is US government floating rate notes. Float, however, holds corporate bonds, but it's from investment grade bonds. It's not like that BILZ that I showed in another video that was all basically junk bonds, below investment grade. This is investment grade. It's financial institutions, banks, lower risk stuff. However, this one is riskier than the US Treasury one. They have a chart here. This shows the credit risk. The one on the left here is the lowest. This is TFLO, Treasury, they call them floaters, Treasury floaters. So TFLO, this is only the quality, US Treasury, duration says 0. Now, even though it's a 2-year, that's sort of deceptive because it resets every week. They listed as 0. Now, this pamphlet here is not up to date. This is actually 5.11% now, and I think it's going up. So the next time the Fed increases rates, this should be even higher. So I think this is the perfect fund to hold if you don't want to have to keep buying CDs and flipping them and selling them early, or doing the ladder CDs where you go from one, you sell it, and then you spread it out where you have a bunch of different lengths. That sounds like a lot of work to me. This one, unlike the US Treasury, which only pays you quarterly, this one pays you, the ETF pays you monthly. So you get a monthly interest. You can buy and sell this on a regular platform that you're used to, like Schwab, E-Trade, Fidelity, Vanguard. You don't have to go through the clunky Treasury Direct website. The second one here, the floating rate bond, it has a slightly higher yield, but the price goes up and down more often, and there's also a greater risk. There's a greater credit risk that they'll fail. There's also, they have two listed here that are even higher rates, but I'm not going to list these because these are either not very popular or they're just launched recently, because each of these only has, like, when I go to Yahoo Finance and I put in the ticker, it's only about $30 million invested in each. So that's really too small to get into at this point. So I'm going to skip those for now, and maybe when they get larger, I'll consider them, but it's also higher risk. And also, if you wanted to do a floating rate loan, I just looked, a higher risk. Fidelity has a mutual fund floating rate that's, I believe, the same rate, about 8.5%. And of course, it's going to be higher risk than the Treasury floater. Here you can see TFLO. It's based on the Bloomberg U.S. Treasury Floating Rate Index. The reference rate is the 3-month T-bill auction rate. The coupon reset is weekly. The expense ratio is 0.15%. The U.S. Treasury created these floating rate notes in 2014, and February 3rd, 2014, TFLO was created. So this is the only one that I could find that actually does exclusively U.S. Treasury rate notes. And so that's why I know Fidelity has a couple of new ETFs that are ultra short-term bonds, but they're so new that it's sort of like the CLOA. It's very little money invested in. If it has less than $1 billion in net assets, I'm not interested in it at this point. I mean, for something like a money market, it should have billions, not, 30 million or something. What's the downside of this? The rates aren't going to go up forever. When the rates go down, this is going to go down in value. Here you can see on this Investopia website, it says a floating rate note is a debt instrument with a variable interest rate. FRNs appeal to investors because they can benefit from higher interest rates since the rate on the floater adjusts periodically to current market rates. There's no guarantee that FRN's rate will rise as fast as interest rates in a rising rate environment. It all depends on the performance of the benchmark. The FRN bondholder may still have interest rate risk, meaning the bond's rate underperforms the overall market. At this point in time, it's actually performing better. Most of the other bonds, if you look at the longer term bonds, they're doing much worse than this ETF. Now here I found a research article or a website. This is from UCLA, a safer Treasury bond. The government's floating rate notes feature an added measure of security, higher interest earnings in times of rising rates. I mean, sounds like the perfect time right now. U.S. Treasury bonds are widely considered the safest securities on earth. The U.S. Treasury introduced 2-year floating rate notes, or FRNs, in 2014. FRNs pay interest that adjusts to reflect changes in short-term market rates. This happens every week for the note's 2-year terms. In times of rising rate, that feature removes from FRNs the biggest risk that the Treasury buyers face, the dangers of getting locked into a low rate while newly issued bonds are paying more. This is what I was saying with the CDs. I just did a video on 5% CDs, and a lot of them were 12 months. And I saw one that was 6 months and they sold out right away, because obviously that's going to be more popular than the 12-month, because 6 months in, the 5% seems good now, but 6 months from now, people are going to be getting 5.5% probably. The first 6 months it looks good, but then the other 6 months you're going to be getting a worse rate than what others are getting. This is where this really jumps in. You've got the flexibility of being bought and sold on any platform. You've got monthly interest versus quarterly, and you can buy and sell it whenever you want. And the rates are going to be changing all the time. You're not going to be stuck. The market prices for floating rate notes have fluctuated very little from the maturity value of $100 per bond. The volatility of market price over the entire life of the floating rate note issue is typically only about 2 to 6 cents per $100. That makes FRNs among the most stable collateral or store of value options available in financial markets. Although the notes don't mature for 2 years, investors consider them virtually as good as cash at any moment. What does that mean? That's basically a money market or a checking account. By contrast, say you have a conventional fixed 2-year Treasury note. If you have to sell it before it matures and the market interest rates on the new 2-year notes are sharply higher than the yield on your note, a buyer would pay a discounted price from $100 par value to reflect the notes below market yield. The amount of the discount would depend on the difference in yields, but could easily be measured in dollars rather than pennies. The new notes technically auctioned by the Treasury once a month. Individual investors can buy them directly from the Treasury, free of fees, by opening a Treasury Direct account. So this is another option. So if you wanted to buy, you could just hold on to it, and the interest rate, the rate should be increasing as they increase it. But then you're going to get the interest quarterly instead of monthly. And when you go to buy and sell, you're going to have to go through that clunky interface. So I think for a 0.15% fee, this is not so bad. And if you look at how much money people have put into TFLO, it's $4.5 billion. So other people have gotten the same idea. And rather than having to deal with the clunky interface and doing this, weird amount of $100 at a time, you could, basically buy it like a stock through the ETF and pay a small fee. And of course, the returns may be slightly lower, but you've got the convenience of the ETF. And you can quickly move money out. So as the market conditions change, if you wanted to liquidate, if you have TFLO and you're just holding off until your favorite stock or index goes down, stock index goes down, you could hold on to this. As your stock or index drops in value, you could liquidate this quickly and then use the proceeds to buy the index or stock that's fallen in value. Whereas if this is locked into this Treasury, it'd probably be a lot more difficult to move money around quickly after that and then buy the index or stock. The T-bill yield closely tracks the Federal Reserve's benchmark short-term rate known as the federal funds rate. It is a T-bill yield plus a spread set by the Treasury each FRN issue at auction. This is an old article, but the spread was 2.4% plus for a total yield of almost 2.54%. This is, of course, much higher than that now. The Treasury interest is subject to federal income tax, but is exempt from state and local income tax. On maturity, the FRN owner would be refunded the note's full par value. So when the interest rates fall, it could fall in value. And I don't think that's probably an issue to be concerned about until, probably towards the end of this year, we'll maybe see what's going to happen. But it seems like for now, this is the perfect option for a rising interest rate environment. It's better than long-term bonds are really bad. Shorter-term bonds aren't doing as well. And when you look at regular money market accounts, this is going to be safer and the yields are going to be higher. And you're getting closer to the source. You're getting closer to the Fed funds rate, and you're not getting the credit risk from banks and corporations. This guy, Fleckelstein, showed that investors are so enamored by FRNs that they have often bid aggressively to buy them up when the Treasury has auctioned new issues each month. This is a thing I've also mentioned. So they mentioned the stability premium. And if you look at the ETF, there's more days that it's actually sold at a premium than a discount. And that's kind of unusual. And I think it's still not such a high percentage that it's to be concerned too much about, but it's kind of a popularity thing right now, and they seem to be very popular. Now here's their holdings. You see it says Treasuries, 19%. They have eight of these, I believe. 1, 2, 3, 4, 5, 6, 7, 8. The more recent ones are near the bottom. So you can see the maturity date. This one is 2025. 2024, and then you can see the rate, the yield to maturity for each. So this is 5.06. You can see there's a high rate. Now they have cash in a money market. I'm wondering if this is to actually pay the monthly dividend or interest. This article here from iShares shows the mechanics of U.S. Treasury floating rate notes. Put cash to work. Get cash invested in short duration Treasury. Since the coupons reset with changes in short-term interest rates. That's basically like the Wealthfront account I have. It's basically 3 days. With the Wealthfront, it's usually 3 days after. I guess this is pretty similar. Excess high-quality floaters. U.S. government Treasury floating rate notes are U.S. government bonds with coupons that periodically reset using 3-month, 13-week Treasury bill rates. The securities are backed by the full faith and credit of the U.S. government. They're issued with 2-year maturity. Each quarter, they have an auction for these. So it's 4 times a year. January, April, July, and October. Here's the Fed funds rate. You can see the Fed funds rate is in green. And you can see the Treasury floating rate yield, which is pink. And you can see that it's actually going up to pretty much match it almost exactly. Now you can look here, government money market funds. The government money market funds is also going up similarly. but the yields are lower. As you can see here, the yields are lower with the government money market funds. So this is one reason I like this so far. It seems like the perfect thing for this type of environment right now with the rising interest rates. Here's an example of how do the coupon resets work. They're adjusted based on the formula coupon equals 13-week T-bill high auction rate plus fixed spread. The Treasury floating rate notes pay coupons based on the highest accepted discount rate of the most recent 13-week T-bill auction, which occurs every Monday. The coupon will update the following business day. Wow, so that reset actually occurs the next day. That's actually quicker than the Wealthfront cash account, which takes, I think, 3 days. The accrued interest from the resets is paid out quarterly. So here's an illustration of a coupon reset. Coupon at issuance. Okay, this would be 1.95%. This would be the spread, 0.05%. So it's 2% coupon. Now they're showing the coupon at the first reset. So the rate goes up to 2.05%. That's the highest rate. And then the fixed spread is the same, so then it's 2.10%, and then so on. This shows how large the floating rate note market is. It started in 2014, so it's not as large as the others. It's grown from $15 billion in 2014 to $626 billion as of September 30th, 2022. The total market for the U.S. Treasury debt is $23 trillion. So you're talking about only $626 billion to $23 trillion. Floating rate notes comprise only 2.6% of the total. You can see here the market value of floating rate notes. So it took off 2014 and it just keeps going up. And you can see it's the smallest out of the U.S. government debt. It's only 2.64, whereas the next one would be TIPS and then T-bills. A lot of you may be asking, what about the Fidelity? What about Fidelity money market accounts? You didn't mention anything about Fidelity. So I'm actually going to mention a little bit. Fidelity didn't win for any of the money market funds as standalone, but that doesn't necessarily mean they're bad. And I know there's a lot of Fidelity fans out there. So Fidelity, when I log into my Fidelity account, I have 3 options. I have SPAXX, which is the Fidelity Government Money Market Account. I have FCash, which is the FDIC insured one, and there's another one. And the FDIC one is a much lower rate, so I'm not even going to list that one. That's a kind of a separate thing. But you have SPAXX and this other one. Now the rates between SPAXX and the other one are almost the same. The thing I don't like about Fidelity is the expense ratio is higher than all the others. It's 0.42%. And, if that's something that's a higher returning like stocks over the long term, maybe you could tolerate a slightly higher fee. But for something that has such a low return like money market accounts, the 0.42% really starts to chip away at the returns. When you look at the yield on this, the 7-day yield, that's the one I've been comparing. I compare the 7-day yield or 30-day yield on all of these, whichever, for ETFs, I think it's 30-day yield, but 4.2%. Now, when we looked at my top rated one, Vanguard, it was 4.5%. When we looked at the ETF at the end, it was 4.56% for TFLO. And for the corporate floating, it was 5.11. Even the Schwab Money Market Mutual Fund that I recommended, the Schwab Value Advantage Money Fund, it had a 4.48%, and the government-only Schwab had a 4.26. So both of those are higher than the yield on the SPAXX, and the other one that Fidelity has is about the same. And also, I looked at the 1-year return. So some of the longer-term money market accounts lost money in 1 year, and the weaker ones like Fidelity, it did probably maybe 0.2% less return than the others. That's not saying that it's bad. If you already have a Fidelity account, there's a lot of nice features that they give you with Fidelity. So you've got the check writing, you've got the direct deposit. You can basically set it up like a bank account. So although you're getting slightly worse performance on the money market account and you're getting higher fees, slightly higher fee, you've got a lot of features they give you, and it's still going to be way better than most bank accounts. So it's not all bad. So let's look at the other one they have. The other one is the Fidelity Treasury Money Market Account, SWVXX, and it's almost the same performance. You look at the 1-year return, you look at the fee is the same, 0.42. I'm not quite for sure what this is. It says 0.28. I don't know if they had some type of a discount on the fee, but it's still, it's the highest fee out of all of them, at least, with what's written down. Now we look at the 7-day yield, 4.2, just like the other one, the same like the other one, you've got all the features, the check writing, the direct deposit. So Fidelity is not all bad, but it would be nice if they lowered the fees and increased the performance a little bit. And I know Fidelity has more than just these two, or just those three that I mentioned. They have some other ones that are like a high net worth, that are like $10,000 minimum investment or $100,000 minimum investment. I'm not sure. I get the two confused. I know Schwab has one, I think that's $100,000 minimum. I've left all the high investment ones off. This is basically for the everyday investor. I didn't do any of the high net worth ones. So if you're a high net worth person, or you've got 100,000 or several million, you may have other options out there, but I didn't include them in this video. I have some Schwab ones that I left off just because they were slightly worse performance than the ones that I mentioned. So I left those off. So in summary, I like Vanguard Federal Money Market Fund. That's my #1 mutual fund pick, VMFXX. If you have less than $3,000, then I would say go with the Schwab Value Advantage Money Fund, Investor Shares, SWVXX. That's a 4.48% yield. If you want something that's slightly safer, then go with the Schwab Treasury Obligation Money Fund Investor Shares, SNOXX, and that has a 4.26% yield currently. As for the ETFs, I would go with the iShares Treasury Floating Rate Bond ETF TFLO, which has a 4.56% yield, or for maximum yield, I would go for the iShares Floating Rate Bond ETF, which invests in corporate bonds. It has a yield of 5.11%. Thanks for watching. I hope you like this video. Please like and subscribe. It really helps the channel like this. Have a good one.